They didn't see it coming. Not in 1929, not in 2008, and today, most still don't, even though the signs are flashing in red again. In 1929, the streets of Wall Street were filled with optimism. Stock prices were rising every day. Ordinary people, factory workers, farmers, teachers, were taking out loans to buy stocks. They believed the future could only go up. And then, in a matter of weeks, everything collapsed. The Great Depression began, and for a decade, the world suffered the consequences. In 2008, it was different, or so they thought. Housing prices had never gone down nationwide in American history. That was the assumption. The banks were smarter. The regulators were more prepared. The financial system had layers of protection. And yet again, it fell apart, bringing down the global economy and wiping out trillions of dollars in wealth. Now, as we stand here in the 2020s, we see similar patterns. Explosive growth in asset prices, record-breaking debt levels, tech bubbles, corporate greed disguised as innovation, and blind confidence that this time is different. But what if it's not? What if the lessons from 1929 and 2008 were never truly learned? Because here's the thing, financial collapses don't start with crashes. They start with confidence, with euphoria, with too much money chasing too few real ideas. Crashes come later when it's already too late. To understand what's coming, we have to go back, way back. Not just to 2008, not just to 1929, but to the mechanics of how financial systems rise and fall. Before the 1929 crash, the Roaring '20s were a time of economic boom. Cars, radios, washing machines, technology was transforming life. The stock market became the hottest trend. Everyone wanted a piece. Brokerage firms extended easy credit. Margin loans exploded. People could borrow 90% of a stock's value and only put 10% down. If it went up, you got rich. If it went down, you lost everything. But why did it go up in the first place? Because optimism feeds on itself. Prices rise, people buy. Prices rise more people buy. It's not about logic, it's about belief. The belief that this time is different, that prosperity has no ceiling. That risk is just a word used by people who missed out. And then one small tremor shakes the entire system. A few institutional investors sell. A rumor spreads. A big bank restricts loans. The crowd panics. The sell orders flood in. But there's no one to buy. Prices drop like a stone. Brokers call in loans. Investors sell more to cover margin. The panic feeds the panic. By the end of it, over 90% of the stock market's value vanished. Banks failed. Businesses collapsed. Unemployment soared. The pain was global, and the question that echoed through history was, how did no one see this coming? The same question was asked again in 2008. Leading up to that crash, the financial world had changed. It wasn't stocks, it was housing. The idea was simple. Real estate always goes up. Everyone believed it. Banks, investors, governments. So loans were handed out to people with no income, no assets, no documentation. They were packaged into mortgage-backed securities and sold to pension funds and foreign governments. On paper, these products were rated OAA, the safest possible. In reality, they were ticking time bombs. But again, there were warnings. A few voices rang the alarm. But they were ignored, mocked, or silenced. Because when money is being made, no one wants the music to stop. And then the defaults began. One by one, homeowners couldn't pay. The securities unraveled. The banks were exposed. Lehman Brothers collapsed. AIG needed a bailout. The global financial system froze. It wasn't just a housing crash. It was a confidence crash. And once again, it wasn't just the poor or irresponsible who suffered. It was the middle class, the retirees, the everyday people who believed the system was designed to protect them. Now we are here again. This time, it's a mix of everything. Housing is inflated again. Stocks, especially tech stocks, are priced to perfection. Corporate debt is at an all-time high. Government debt has surpassed levels never seen in peacetime. And the newest twist? Cryptocurrency? A $3 trillion market built on the promise of decentralization and digital gold. But also built on speculation, hype, and in some cases, fraud. And yet the optimism remains. The average investor, the same kind who believed in dot-com stocks in 1999 or subprime mortgages in 2007, now believes in meme stocks and NFTs. Billionaires joke about manipulating prices on social media. Tech CEOs speak in vague visions of the metaverse and artificial intelligence, while their companies burn billions in cash. And governments keep printing money, running deficits, and expanding credit. The financial system has become a house of mirrors. Every reflection looks strong until you get too close. And then it distorts. Let's look at a few numbers. Total global debt has surpassed $300 trillion. The U.S. national debt alone is over $34 trillion. Corporate debt has doubled since 2008. Student loan debt is over $1.8 trillion. Credit card debt in the U.S. has reached record highs. And interest rates, after years of being near zero, are now rising. Fast. Why does that matter? Because for over a decade, the economy was addicted to cheap money. Businesses borrowed to expand. People borrowed to buy homes, cars, and stocks. Governments borrowed to fund everything. When rates rise, that party ends. The debt becomes harder to service. Payments rise, defaults begin. History tells us this isn't new. In every financial collapse, the warning signs come early, but they're ignored because the system doesn't want to hear them. The profits are too good. The bonuses are too big. The campaign's too expensive. The lie's too comforting. And when the crash comes, it always comes faster than expected. Because risk is like gravity. It doesn't matter if you believe in it. When the fall begins, it pulls everything down. The red flags are already here. Banks are once again highly leveraged. The biggest tech companies are laying off thousands. Real estate bubbles are bursting in China, Canada, and parts of the US. Inflation is squeezing middle-income families. And the Federal Reserve is trapped. Raise rates, and you kill the economy. Lower them, and you fuel another bubble. What's coming next? That's the real mystery. Is it another housing collapse? A bond market implosion? A tech crash? A banking contagion triggered by a sovereign default? Or is it something we haven't seen yet? Something bigger? Because every collapse has a fingerprint. But they evolve. They adapt. And the next one won't look exactly like the last, but it will feel the same. It will start with calm, then confusion, then panic, then silence. And after the silence, the blame. But by then, it's always too late. Where are you watching from? Type your country in the comments, because this isn't just an American problem. This is a global system built on shared illusions. If you're watching this and feel the tension building, you're not alone. You're early. And being early is better than being too late. Like this video, if you're starting to see the patterns, we're just getting started. The aftermath of a crash is not just financial. It's psychological. It reshapes how people think about money, safety, and trust. After 1929, a generation grew up afraid of banks. People hid cash under mattresses. They avoided stocks. They cut spending. They lost faith in the system. After 2008, it was different, but just as deep. Millennials came of age watching their parents lose jobs, homes, and retirement savings. They entered the job market during a recession, saddled with debt, priced out of housing, and skeptical of Wall Street. That skepticism gave birth to new financial movements, crypto, FIRE, DeFi. But ironically, many of these became bubbles themselves. That's the pattern. Crisis leads to reform. Reform fades to comfort. Comfort gives way to excess. And excess, unchecked, becomes collapse. So why don't the fixes work? Because many aren't fixes at all. They're band-aids, cosmetic solutions to structural problems. Take quantitative easing. After 2008, central banks flooded markets with trillions of dollars. The idea was to stimulate lending, boost asset prices, and kickstart recovery. And it worked, on the surface. Stock markets soared. Real estate boomed. Corporations borrowed cheaply. But underneath, the risks were just being transferred, shifted from banks to governments, from private debt to public debt. And every time the market stumbled, the response was the same. Print more, borrow more, intervene more. But here's the hard truth. Every time you push off a correction, you make the next one worse. In 2008, the system was bailed out instead of being reset. Bad debts weren't punished, they were absorbed. Executives weren't jailed, they got bonuses. Banks weren't broken up, they got bigger. And the signals that used to warn of collapse were muted by artificial money. It's like seeing smoke, turning off the alarm, and pretending the fire went away. But fires don't vanish. They wait, and when they return, they burn hotter. Now, let's fast forward. Today, a staggering amount of money has been created out of thin air. Since 2020 alone, the U.S. Federal Reserve increased its balance sheet by more than $4 trillion. That's more than during the entire 2008 financial crisis. Central banks in Europe, Japan, China, they all followed suit. And that unleashed an everything bubble. Stocks went to record highs. Real estate in cities like Austin, Toronto, and Sydney doubled. Crypto exploded. NFTs selling for millions. SPACs, meme stocks, tech IPOs with no profits, no revenue, just hype. And while Wall Street cheered, the average person struggled. Inflation came roaring back. Essentials, food, gas, rent became unaffordable. Wages couldn't keep up. Savings were eroded. And slowly, the middle class began to feel like passengers on a ship going faster, but headed straight for an iceberg. That's the contradiction of modern finance. The markets signal prosperity, but the people feel pressure. The headlines speak of recovery, but households speak of survival. Why? Because we've mistaken financial engineering for economic growth. Real growth comes from productivity, making better things, faster, with less. But recent decades have seen more profit from manipulation than innovation. Corporations buy back shares to inflate prices. Governments manipulate interest rates to avoid pain. Investors chase speculation over substance, and when reality doesn't match the numbers, the crash comes. So what are the red flags today? Start with housing. In places like Canada, New Zealand, and parts of the US, home prices are 10 to 15 times average income. Historically, 3 to 5 times is healthy. That gap is unsustainable. It means people are over-leveraged. One rate hike, one job loss, and defaults begin. Then there's corporate debt. Junk bonds, risky loans to companies with weak credit, are being packaged and sold again, just like subprime mortgages in 2008. Except now, they're called CLOs, collateralized loan obligations. New name, same danger, student loans are another time bomb. In the US, over 45 million people owe nearly $2 trillion. Many can't repay. Payment pauses and forgiveness programs help temporarily, but the debt doesn't vanish. It lingers, and it drags on consumption and mental health. Now look at banks. Some are exposed to risky real estate markets. Others have heavy investments in government bonds that lose value when rates rise. And small cracks are already showing. Bank failures in 2023, liquidity concerns, emergency lending by the Fed, these are not normal. And yet, markets continue upward. Why? Because of belief. Every bubble is built on belief. The belief that someone else will pay more, that the system will always be saved, that the crash won't come, or if it does, you'll be out before it hits. But crashes don't ring bells. They arrive slowly, then suddenly. In 1929, it took weeks. In 2008, months. But the tipping point came without warning. That's how confidence collapses. Gradually, then all at once. And that brings us to the global dimension. This time, it's not just one country. China's property sector, once 30% of its GDP, is collapsing. Evergrande and Country Garden defaulted on billions. Ghost cities, unfinished skyscrapers, and local governments drowning in debt. Their financial crisis is unfolding quietly, but its impact will echo loudly. In Europe, energy shocks from war, aging populations, and rising debt make the region fragile. Japan has lived with ultra-low rates for decades and has no easy path to normal. Emerging markets? Many borrowed in dollars. As the dollar strengthens, their repayments explode. Currencies devalue, inflation rises, civil unrest follows. This is a global powder keg. And all it needs is a spark. So what could that spark be? A sovereign default, like what almost happened with Greece, or what's brewing in places like Sri Lanka or Argentina. A tech crash triggered by disappointing earnings, layoffs, or tighter regulations. A currency crisis, if a major fiat currency loses trust, a geopolitical shock, a war, cyber attack, or sanctions that freeze markets, or even a loss of faith in the central banks themselves. If people believe that the people in charge no longer have control, panic sets in, because all collapses are at their core. Collapses of trust. Trust in the banks. Trust in the system. Trust in the future. And once that breaks, everything built on top becomes unstable. But don't mistake this for fear-mongering. This is awareness. Because being aware is how we protect ourselves. Not by panic, but by preparation. You're not here by accident. You're watching this because you sense the tension, the patterns, the déjà vu. And you're not alone. Tell us in the comments what red flags you've noticed around you, in your city, your country, your market. You might help someone see what they've been missing. If this has opened your eyes, like this video now, the next part will give you the clearest picture yet. What we can learn, what we must do, and what we must not repeat. So what do we do now? What do we take from 1929, from 2008, and from what's unraveling right now in front of us? Because watching history isn't enough. We have to listen to it. Let's break this down into 3 vital takeaways. Lessons that repeat across every financial collapse, and we'll decide whether we sink or survive when the next shock hits. First, understand this. Easy money always comes at a cost. Every boom fueled by cheap credit ends in a bust. It's not a matter of if, but when. From the wild speculation of the 1920s to the housing mania of the 2000s and the asset bubbles of today, low interest rates create artificial demand. They inflate valuations beyond reality. They encourage borrowing, leverage, and risk-taking. And when that reverses, when rates go up or cash tightens, the house of cards begins to wobble. If you see a system where growth is driven not by productivity but by borrowing, take notice. That's a red flag. Second, watch behavior, not headlines. Crashes don't happen when things are bad. They happen when things appear too good. When everyone's making money, when the crowd is euphoric. That's when the seeds of collapse are planted. In 1929, they were dancing in the streets. In 2007, home prices were doubling overnight. In 2021, meme stocks were making millionaires overnight, and JPEGs were selling for millions. That wasn't progress. That was madness. Pay attention to how people behave with money. When due diligence dies, when skepticism fades, when everyone is a genius, start preparing. Third, and maybe most important, don't rely on institutions to protect you. The government didn't stop the 1929 crash. The Fed didn't prevent 2008. The SEC didn't see FTX or Wirecard or Archegos coming. Regulators act after the damage is done. Bailouts come with strings. And the system, despite its talk of safety, often protects itself first and people second. That doesn't mean panic. It means prepare, have cash reserves. Diversify your income. Educate yourself. Don't over-leverage. Don't chase hype. Build your own financial resilience, because when the storm comes, no one's going to do it for you. Now let's talk about what might come next. Because while no one can predict the exact trigger, We can read the patterns. A tech crash is increasingly likely. Many companies today are still priced for perfection, but perfection doesn't exist. AI is powerful, yes, but many of its promises are still years away. If the next wave of tech doesn't deliver real profits, not just projections, the floor will fall out. A housing correction is not off the table, especially in markets where prices have far outpaced wages. If unemployment ticks up, if rates stay high, we could see foreclosures rise again, and then there's the geopolitical risk. Taiwan, Ukraine, Israel, oil, cyber attacks, all of these are real threats. Global instability affects markets faster than ever. One domino can set off a chain reaction, but maybe the most dangerous possibility is a trust event. The moment people stop believing their money is safe, at a bank, in a currency, in a government, everything unravels fast. That's what happened during bank runs in the Great Depression. It's what almost happened with SVB and Credit Suisse. Digital banking accelerates that risk. With a few taps, billions can be withdrawn in hours. The next crisis won't need a week. It'll need a weekend. That's the risk of speed in a system that's built on confidence. So what should you do right now? Start by asking better questions. Is your financial life built on assumptions or facts? Are you depending on rising asset prices to stay safe? Are you hedging against inflation, against deflation, against shocks? Do you know where your money is? Who holds it? What backs it? These aren't conspiracy questions. They're survival questions. Because you don't get to choose when the crash comes. You only get to choose how prepared you are when it does. History doesn't repeat word for word, but it rhymes with brutal precision. There were red flags before 1929. They were ignored. There were red flags before 2008. They were dismissed. Today, the red flags are blinking again, and this time, you have no excuse not to see them. You have the data, the history, the hindsight. You have the knowledge. The only question is, what will you do with it? Some will laugh. Some will click away. Some will forget this video by tomorrow. But a few of you will take action. You'll study. You'll diversify. You'll protect your family. You'll speak up. You'll become the voice in your circle that says, wait, look again. And when the next chapter of financial history is written, when analysts look back at the crash of the 2020s or the decade of disruption, you will not be among the surprised. You will be among the prepared. This is not fear. This is foresight. This is not panic. This is positioning. This is not paranoia. This is pattern recognition. Because every single major financial collapse was clear in hindsight. This time, let it be clear in foresight. Tell us, where are you watching this from? Comment your country, your city, your concerns. This is global. This affects all of us. If you saw something today you've never heard before, if this made you pause, think, or question, then please hit the like button. Not for us, but to tell the algorithm that people still care about truth, not hype. And if you want more breakdowns, more untold history, more warnings backed by data and not fear, then subscribe now. Join the community that doesn't just scroll past the signs. We study them, we learn, we adapt because the future is uncertain. But your understanding of it doesn't have to be. We'll see you in the next video. Until then, stay sharp, stay skeptical, and stay ready.